Good afternoon and welcome to our virtual workshop, Pitfalls and Practice Tips in Preparing Form 990 PF, hosted by PKF O'Connor Davies. All attendees are in listen mode only. Before we get started, I'd like to go over a few housekeeping items so you know how to participate in today's call. We've taken a screenshot of the attendee interface, and you should see something that looks like this on your own computer desktop in the upper right corner. You'll have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the webcast. We have a lot of material to cover, and if time permits, we will make an effort to respond. If we cannot get to your questions, a response will be sent post-event. This webinar is offering 3 CPE credits in taxes, and you'll need to respond to 10 polling questions to receive credit. If you are having difficulty responding to a question, it is recommended you come out of full screen mode to respond. CPE certificates will be issued within 8 to 10 days via email. A recording of today's webinar will be made available to you via email a few hours after the event. At the end of the webinar, we do have a very short survey, which will be prompted at your response, and it's greatly appreciated that you complete it. At this time, I would like to introduce Tom Blaney, co-partner in charge of the private foundation practice with PKF O'Connor Davies. Tom?
Holly, thank you very much, and good afternoon to all you folks in the East Coast, and good morning to our friends on the West Coast. We're going to try and do our best. Let's face it, pitfalls and practice tips in preparing the Form 990 PF is really not a sexy topic, but the folks here on this call, on this webinar, this workshop, are going to try and do our best. And as Holly said, it's 3 CPE credits for those folks on the webinar that need CPE, so it's in the taxation arena. Maybe before we start, I just want to thank John Tyler for joining us. John and I have spoken numerous times over the years on self-dealing issues and basic private foundation issues for a bunch of different groups. And John is in-house counsel, general counsel for the Kauffman Foundation in Missouri, and probably the go-to attorney in the self-dealing arena today. And also the other folks from our private foundation practice that will be speaking, Tanya Miranda. Tanya, say hi. Tanya's going to be talking a little bit about the minimum distribution rules, qualifying distributions, and all that nice stuff. And we have Eric Hillman on certain aspects of the grantees. And my other 2 partners, Joe Ali and Anand Samara, will be going page by page in different aspects of the form. Also, everybody that signed up, and we have about 200 individuals that signed up, so it's a pretty good audience. They're going to be getting at the end what we call our private foundation governance and tax primer. It's really a basic fundamentals of about 10, 12 pages. It really helps a new trustee or even a new preparer learn some of the basics of private foundations. Mike Konicki, one of our senior managers in our group, put it together about a month ago, and it's just a good tool that you can look at. It's not, doesn't have everything you need. It's not as equivalent to the Bruce Hopkins book, which is a few hundred pages, but it has the really basics that helps, well, with the buzzwords that actually help a new trustee or somebody just getting into the foundation world for the first time. What I'd like to do is just from a 50,000-foot point of view is talk about where the word private foundation came from and the history of private foundations. Then I'm going to turn it over to Anand to go page by page of the PF. So really, the word private foundation actually came from the 1969 Tax Reform Act. And leading up to the 1969 Tax Reform Act, there was a congressman out of Texas named Wright Packman that started right around 1961, 1962. The word was he really had it in for private, the so-called private foundations, really what the word was, charities there that had endowments that were giving out money at the time. And he actually put in-house committees together to go after some of the large, some of the family foundations. He was complaining that back in the Kennedy administration, private foundations were indirectly giving the Kennedy administration staff his money for in travel allowances for certain so-called philanthropic trips that maybe weren't philanthropic trips. They might have been personal in nature. So he basically took it upon himself to, I guess, what's the word, to really push for the oversight of private foundations. So it got to the point where there was actually congressional hearings that started in February of 1969 on private foundations, and Wright Packman actually chaired that committee. And he went in attacking family foundations, the large foundations. He was very critical of IRS's weak oversight of foundations. But what ended up happening, about 7 months later, President Nixon signed the Tax Reform Act of 1969. That's some 53 years ago. That put in these so-called antiquated self-dealing rules that John is going to go through. Put in 3 other things that really separate a private foundation from a public charity. Well, there's 4 altogether. There's a self-dealing. It's the first time ever the statutory word private foundation came into existence. Then they had to put into place a 4% excise tax on your net investment income. And the purpose of the excise tax then, and I don't know, maybe even possibly now, was to fund IRS oversights of private foundations. Back then, they guaranteed that every large foundation, and it was never defined what a large foundation is, but a couple of attorneys that worked on the 69 Reform Act told me if a foundation had more than $500 million back then, they were considered a large foundation. What that guaranteed was every large foundation would be audited every other year at a minimum, and all the foundations in the universe would be audited once every 5 years. And Nan is going to get into how that went down to 2%, 1%, and now we're at a flat 1.39%. Last but not least, the other one of the 4 items that kicked in the 1969 Reform Act, that there was a minimum distribution requirement put into place. Not 5% as we have today, it was actually 6%. And that actually went down to 5% following that. And again, Tanya's going to go over the definition of what a qualifying distribution is and get into all that lovely stuff. But one thing I wanted to mention, there was a Senator Gore from Tennessee, Al Gore's, the vice president's dad, that was very involved in the regulations. And he was pushing for a 40-year term limit for every foundation that was set up, whether you were set up as a corporation or a trust. And that never made it to the final. But I know every once in a while in the new legislations that we hear about today, proposed legislations, there's always certain talks about a foundation, possibly a new foundation sunsetting after 25 years, or certain incentives if a foundation would sunset after so many years. Hallie, can we go to the next slide? I just want to go over CPE question number 1. And we're not going to go over the answers, but this is a common question that we put out in all our CPA polls. 1, are you looking for CPE credit? So all our people out there that are, you check it either yes or no. Hopefully you check it yes. And Anand, I'm going to turn this over to you now to start with page 1 of the 990 PF, if that's okay.
Thank you. Difficulties there. Thank you, Arlene. So let's just overview of the 990 PF, as Tom gave us a little history about the 990 PF and what the 990 PF does. I think the most important thing to know about the 990 PF, it is a public document. Anyone who wants a copy of the 990 PF can simply Google the name of the foundation, 990 PF, and it is available and on many websites. And it really has, the 990 PF has a wealth of information about any given foundation. Your officers, the directors, the names, their compensation, employee compensation is there as well. Every grantee that you make a grant to is also listed. Every investment that a foundation is in is also required to be listed there as well. So again, a lot of information, and we always say we want to make sure that the return is completed as accurate as possible. So with that said, I would just maybe, I'll just go to the next slide if you don't mind. So we really front loaded some of these questions for those who are looking for CPEs. So our next question is, are you familiar with the IRS Form 990 PF? Okay. Arlene, you mind take us to the next slide? Okay, and one more question before we move on. What type of accounting method is used to prepare your non-90 PF? Accrual, cash, modified cash, or other? Okay. Arlene, you mind moving, go to the next slide? All right, so what I'm going to do, as Tom mentioned, I'm going to take everyone through the first 2 pages of the 990 PF. And unlike most IRS filings, the 990 series, not only does it have an income statement, but it also has a balance sheet. So those are the 2 pages I'm going to start with. The page 1 of the 990 PF, I think I'd say it's probably one of the most important pages of the 990 PF, not only because I'm covering it, but also because it truly touches on many aspects of a private foundation and whether it's the financial disclosures, the excise tax that Tom mentioned earlier, the amount that foundations pay their excise tax is disclosed on page 1 as well, but also the amounts that are distributed during the year that go to satisfy that distribution requirement, that 5% distribution requirement is also picked up on this page. You know, Tom mentioned the excise tax that used to be 4%. Up till about a couple of years, it was 2% up to about a couple of years, and now it's a flat 1.39% tax. Prior to that, it was a 1 or 2% tax, and foundations were able to reduce that tax if certain criteria are met. But again, that is no longer the case. Also, as you all know, private foundations are required to distribute 5% of their non-charitable use assets. That's a fancy way of saying of their investment in cash balances. And again, that's another requirement. And we'll walk you through that as well. And Tanya will get into a little more detail of what components go into that calculation. So with that said, just high level on page 1 here, you know, the first part of page 1 is a little more informational. It just walks us through the foundation, the name of the foundation, also very important. On top, the calendar year or the fiscal year under the foundation. Here it's a calendar year only because the 2 cells above are left blank. If it was a fiscal year, you'll be required to put in the first day of that fiscal year and the last day. Now, what I mean by that, if it was a June 31st year end, you would disclose July 1st would be the first day of the year, and June 31st would be the last day of the year. We also, of course, the name of the foundation is important, and you're going to hear a common theme about addresses. Which is going to be very important. A lot of times when we do pick up new clients and review these 990 PFs, the addresses, whether it's for the employees or the officers and directors or even the address of the foundation, is someone's personal address. And that's a big no-no. As I mentioned, this is a public document, so you really don't want anybody's personal information out there. Shift over to the left, column A, box A, I should say, is an EAN number. That's an employee identification number. Of course, you have the phone number of the organization that needs to be disclosed as well. You know, box C or not C through F. This is if it's, you know, brand new foundation that may have not received, or it still has a pending application for its exemption. You would check that box. Box E, if the foundation was the status was terminated, you would check that box. Shifting to the left, we're going to spend a little time here on box G. Box G, if the foundation it's a unique year, whether it's its initial return, its final return, an address or name change also is important, or if it's an amended return, the applicable box should be checked off before it's filed with the IRS. A quick story, a couple of years ago, I worked with a foundation, a brand new foundation we just picked up, and their prior accountants amended the return and did not check that box as an amendment. And what happened, the second return went to the IRS without that box being checked off, and the IRS ultimately ended up with 2 returns with conflicting information. And that really caused a lot of confusion. So again, we want to make sure that that box, if it's amended or if the final return is checked off. Further down to column H, or box H, I should say, type of organization, the most commonly seen here is the Section 501c3 exempt private foundations. Further down on box I think this is the first number or the first area I look at when I look at a 990 PF is box I, just to really get a sense of the size and of a foundation. Here, a foundation is required to disclose the fair market value of all its assets. This is the number that will agree to the balance sheet on the next page, column C, line 16. Again, that's important. That number reflects the fair market value. I'm sorry, just if you stay back on the prior slide, Harleen. Column J, box J, again, very important here for many reasons. Here, the method of accounting is required to be disclosed, whether it's cash, accrual, or modified cash. Common error that we see sometimes in that the accounting method is not in line with the accounting method that the foundation maintains its books and records on. So this method should mirror the method that you use internally on your books and records and your financial statements. Now, a common method is a modified cash basis of accounting, but there's really no right or wrong. It could be an accrual basis, a cash basis, or modified cash. It truly depends on the foundation's size and complexity. So that's just a little, again, on the information that you need up front. Next slide. So here's the first part of the income statement, of the income statement, where it really talks about the revenue of the foundation. What's important here, if you see across the top, there are 4 columns: column A, column B, C, and column D. Now, column C, we're not going to get into too much here. Tanya Miranda will cover that later on. Column C is generally completed by operating foundations. What I'm going to go through right now is more geared or related to grant-making foundations. So with that said, column A, what is column A? Column A is, as it indicates, revenue and expenses per books. So this column should mirror your income statement on your financial statements or in your internal, your audited statements or your internal financial statements. For the exception of unrealized gain. So unrealized gain on the 990 PF is picked up or reflected on the balance sheet as an adjustment to net assets, and we'll touch on that on the next few slides. Column B. Column B, ultimately, the bottom of column B is what private foundations pay the excise tax of 1.39% on. So we'll see that later on, and I'll walk you through that as well. Columns shifted all the way to column D. We mentioned the 5% required distributions that foundations have to meet annually. Column D ultimately will represent and disclose the amounts that go to satisfy that distribution requirement. Also very important about column D is that it must be prepared on a cash basis of accounting. Regardless of what accounting your books and records are maintained on, column D must be on a cash basis. IRS and instructions are pretty clear. For dollars to count as qualifying distributions, they must be on a cash basis, meaning cash out the door. A few components of a few line items here I just want to touch on quickly. Line 1, obviously, here is if there's any contributions received, you would see that on column A. Of course, not on column B because contributions are not taxable. Line 2, you would normally have to check that box if no contributions came in during the year, informing the IRS and the reader that the foundation is not required to attach Schedule B. Schedule B is required if there's any contributions. There you would list the contributors and the amount of the contribution. Below that is the interest on savings account, and of course, interest and dividends on securities is on line 4. Further down, on line 6 is net gains from sale of assets. And predominantly, I would say 95% of that is usually sales related to the investment portfolio. And again, you'll see that on column A. A little note I want to just make here that's very important. Column A, you could have realized gains and realized losses, because again, remember, this is per books. Column B, very important, cannot reflect or cannot show realized losses. Column B, if there's a loss in any given year, it cannot go below 0. So that number cannot go below 0. And what it really means, the instructions are pretty clear. Realized losses cannot offset ordinary income, which means interest and dividends. So again, it's important, you should never see a negative on column D for realized losses. Going further down, other income, generally speaking for private foundations, when we talk about other income, it's maybe a return of grant, it could be royalty income or other income generated through the foundation's investments in alternative investments that is recorded on a K1. Next slide. Thank you, Harleen. So again, this is part 2 or part 1 still, but again, this is all on page 1 of the 990 PF. We broke this out so you can, for visually, you can see it a little better. So this is now the expenditures related to the foundation. Again, the same columns A, B, and D. Column A, again, these are expenditures per books. Column D are expenditures that are related to the investments. And the IRS instructions state these are expenditures that have to be directly related to the procurement of income. Now, for the most part, what you will see here is professional fees that are related to investment management or other investment-related expenses. There are some allocations you may see as well, as indicated here. And then when you shift over to column D is your charitable distributions. Right? And important about column D, I'd like to touch on is that generally speaking, almost all expenditures, not just grants, but all expenditures the foundation incurs, for the exception of excise tax and investment-related expenses, do count as for charitable purposes. So I think, again, that's very important. On the bottom of column D is that $2.1 million. Those are the dollars that will go to satisfy that 5% required distribution. You will see that again on slide 45, and Tanya will walk us through some of those components. If we shift over back to column B, the bottom of column B, that $3.7 million, that's the amount that the foundation will pay an excise tax on of 1.39%. That's going to be roughly about a $52,000 liability, and you'll see that again on slide 15 that Joe will walk us through. Back to column A, the 1.5 million on the bottom of column A, that's the change in net assets. That's the income, potentially it could be a loss as well, that will be carried forward to the balance sheet. Just keep in mind that this excludes unrealized gains. A few items I want to touch here, a few line items I think that are important. Line item number 13, the compensation of officers and directors, $185,000. This number you'll see again on part 7, where you are required as a foundation to list all officers and directors and their compensation. So it's important. This is going to agree to part 7 of the 990 PF. Another item I think it's important, or another common error that we see, line 15. This is where a foundation is required to report its pension plan and employee benefits, but also its payroll taxes. An error that we see a lot of times when we pick up new foundations, payroll taxes are reflected in line 18 as other taxes. Again, that's incorrect, and it should only be excise tax or other foreign taxes related to the procurement of income. Further down, again, we have other operational expenses, occupancy, of course, and line 25 are the contributions. Both column A and column B, in this case, agree. They don't always have to agree. In column A, column D, I should say, the $1.7 million, again, that's the contributions. there is a detail that has to be attached to the 990 PF that lists that the grantees, their name, their addresses, and the dollar amounts that would ultimately add up to this $1.7 million. Eric Hillman later on will walk us through those details. Before I move on, I think another item that's important to note here is that losses for a private foundation cannot be carried forward or carried back as in many other returns, whether it's for-profit returns or personal returns. So I think that's important to note. Losses that are incurred are just reflected that 1 year, and again, they're not carried forward or back. And last item I want to mention on the income statement that is very, very important, especially for us accountants. We accountants like when things not only foot down, but also foot across. And it's important to note we shouldn't get too anxious because this page does not foot across. And what I mean by that, if the entity or a foundation is on an accrual basis of accounting, right? Column A would be an accrual basis of accounting. However, column D, as I mentioned, is always on a cash basis. So again, there's no, shouldn't be concerned. It will never foot across. Colleen, you mind moving to the next slide? Thank you. Okay, so this slide here is the balance sheet of a private foundation. Again, this is many tax returns don't require a balance sheet, but the 990 PF does. A couple of things here I think it's important to note. The upper on top, you see again, columns again, column A, B, and C. Column A and B are on the books. Again, this has to mirror your books. Whatever method of accounting you're following, that's what should be reported. Column C, very important, has to be must be on a fair value, fair market value. So your assets, even if you're maybe on a cost basis where you're reporting on column B, your investments on a cost basis, column C must be on fair market value. So again, that's just something that's very important. A few line items I want to touch on here. Again, this is going to mirror your financial statements, but it really has a little more detail. Are required to provide more detail. For example, line 1 and line 2, cash needs to be disclosed, needs to be presented by non-interest and interest-bearing cash. So again, that's broken out. You see here you have an accounts receivable as well on line 3. Line 4, if there's any pledges receivable and grants receivable on line 5. Line 6, also similar to line 20 on the liability section. Here is where a foundation would disclose if they had any receivables or any amounts due to or from an officer, director, or trustee, or a disqualified person. Now, this may be considered self-dealing, and Joe Ali and John Tyler later on will get into a little more detail and really dig into and dive into the self-dealing rules. Further down on the asset section, again, the various investments. Here on line 10, A, B, and C is where you disclose your investments, whether it's corporate stocks, corporate bonds. Further down are the other investments on line 13. On line 13, more, it's where foundations would normally report their private equity investments, their hedge funds, or their mutual funds. Again, standard for many foundations. If the foundation had land, property, and equipment, you'll see that presented on line 14. With depreciation associated with those assets. Line 15, here you see one item or another asset that we have disclosed here is a PRI. And I'll get into a little more what PRI is on down the line. But more and more we see also foundations and other type of assets, non-traditional assets, whether it's art that is held. We see more and more now arts endowed foundations, and that's where they would report their artwork. But also we have more and more foundations receiving, gifts of art, where individuals are just donating their collection of art to private foundations. Again, so that's where you would see the art reflected. Below that, obviously, is your total assets. Before I move on, just one other important item when we talk about the investments. Investments are ultimately presented further in further detail later on private foundations are required to disclose every investment they're in. I think that's important. A lot of times a common error that we see, or that's not done, they're just all summarized. Again, the instructions are pretty clear. They need to be presented, and every investment should be listed. But also, starting about 2 years ago, when now foundations must e-file their 990-PF, you used to be able to attach a PDF document, listing all the investments. You can no longer do that. So again, every investment is required to be imported into the software and ultimately part of the e-filing process. Further down on the liability section. Now here, as you see, we have no liabilities starting on line 17. The reason for that is this return is on the modified cash basis of accounting, meaning there's no liabilities. It's modified to simply record investments at fair value. However, for a typical foundation that is on an accrual basis of accounting, you will see liabilities, whether it's accounts payable and accrued expenses, but also grants payable, generally the largest liability for any private foundation. And of course, other liabilities you may see here are deferred tax liabilities. And now, as the new lease standard has been adopted, many foundations would have the lease liability here as well. Further down on the fund balance section, pretty self-explanatory here. Another common error that we see, or an error that when we do pick up a new foundation, is the line where it says ASC 958. That box should be checked off. And this is for any foundation that follows the net assets classification, meaning a foundation that classifies its net assets between with and without donor restriction. But again, that box should always be checked off. Arlene, you mind moving on to the next slide? Thank you. So brings us to another CPE question. Is your foundation on the modified cash basis of accounting? Yes or no? Okay. Thank you, Arlene. So on the next slide here, this is the last part of the balance sheet. This is part 3 of the 990-PF. This is an analysis of changes in net assets or fund balance. Pretty self-explanatory. Line 1 is the beginning net assets. That should agree to your financial statements, whether audited financial statements or internally prepared financial statements. Line 2 is the net income that was reported, and that would agree to page 1, column A. Lines 3 and lines 5 is where you report any increases or decreases in net assets that were not included in line 2. Here is where foundations report their unrealized gains on line 5, and if it was a loss, it'd be recorded on line 5. However, there are other items that you may see here in this section, or this increase or decrease lines. Deferred taxes would be recorded here as well. If there's a prior period adjustment, you would see that here as well. And lastly, line 6, total net assets on fund balance at $29 million. That number should always agree to your financial statements, whether it's audited, reviewed, or internally prepared financial statements. Okay. So with that, I'd like to turn it over now to Joe Ali to take us through the next few slides. Joe?
Great, thanks, Anand. All right, hi everybody, welcome today. I'm gonna take over from part 4 on until we get to John Tyler to talk about some self-dealing. So part 4, capital gains and losses for tax on investment income. A couple of things to highlight here. It's important to note that sales of publicly traded securities, you're now able to just simply write this on what you see here on line 1A, sale of publicly traded securities, because some of the rules have changed in recent years that you can put that in aggregate. So just the total, and it's actually the foundation's responsibility to maintain the books and records that support that number if the IRS were to ever ask. Years ago, you were actually required to list all of the trades and all of the activity there. Also important to disclose any other capital gains. One important takeaway, though, is if you did have any other gains from other types of investments, such as a limited partnership or what have you, closing out a particular fund, those still need to be detailed on this particular page. Another thing just to kind of lift up here is how the assets were acquired. So you'll see there over in column B in the beginning of part 4, how were they acquired, purchased or donated? And this is really important. We ask clients all the time, or when we're talking to foundations, how did the assets come into the foundation? So we have foundations with living donors that are actively funding their foundation on a regular basis, maybe between them and other family members or friends. And in that case, it's really important to track, which securities have been donated because of the taxability of those particular donations. So if somebody donates highly appreciated publicly traded securities to the foundation, when the foundation goes to sell those securities, it actually sells them at the donor's basis. Again, if anything comes in by way of an estate or part of a will, there's the step up for the date of death, but an important thing just to keep track of there. I think we only have about 2 foundations left in our client base that have securities that were donated before 1969. But there is a little known rule there that if you had donated securities prior to 1969, you automatically get a step up to 1969 values. But again, we're not seeing that too much anymore. But every once in a while it comes across. Moving on to the next slide, part 5. Great, thanks, Harleen. So for those of you that have been looking at Form 990 PFs for many years, there used to be a different Part 5 that came before this. So it changed all the part section numbers or Roman numerals, as it were. The old Part 5, if you remember correctly, was the qualification test for the reduced tax on net investment income from the old 2% versus 1%. Now we just have the 1.39% flat tax. So again, some simplification there that came out of the Tax Cuts and Jobs Act around that time. And now we have Part 5, which is the excise tax based on investment income that you see here. So this part is very important. It calculates that tax on total net investment income. So that column B total that Anand talked about earlier on page 1. This is that 1.39% tax on that net investment income of about $52,000. You see here then, as you go down, if there was any adjustments to it for any other reason, we don't usually see too many other items there unless you're a particular type of foundation. But then ultimately we come to line 6 where we look at, okay, well, what has the foundation paid in and what has the foundation made any payments, for example, with its extension, so on and so forth. An important takeaway here is on line 8. With regards to the Form 2220, we come across a lot of foundations, new foundations that we're working with, where maybe perhaps the former preparer wasn't checking this box and wasn't actually calculating what the gains were throughout the course of the year. And this is really important for large foundations. A slightly different definition of large foundations from Tom's historical definition earlier. But here, with regards to large foundation, the IRS deems a private foundation a large foundation for the purposes of taxes if they had more than $1 million in net investment income in any of the prior 3 years. So if you're one of those foundations, and it's a pretty low bar when you think about it, considering some of the foundation size, if you have more than $1 million in net investment income, the IRS wants its money throughout the course of the year, right? So you want to make sure that you're paid in advance, and kind of looking at your investment activity throughout the course of the year to ensure that you're paid in. Sometimes we get to the end of the year and the foundation has had enough paid in, but it didn't have enough paid in early on enough in the year. And sometimes you might see some small penalties, whether it's $10, $100, a couple $1,000. Sometimes foundations can get caught unawares and just didn't get that payment in early enough. But again, when we work with foundations, we try to mitigate that, always keep foundations just a little bit ahead, while obviously still maintaining the power of their cash and investments. And then ultimately, the return on line 9 would let us know if there's any tax due with the return, in which case a payment would go out via EFTPS with the return when it's being filed to the IRS, and if there's any overpayment. Oftentimes when we have a small overpayment, we usually don't recommend too often to ask for a refund. We try not to confuse the IRS with checks in the mail going back and forth. Typically, by the time a private foundation return is being filed, we can make a decision with the foundation to ensure that that $7,950 it's already working for the foundation and it's been built into their estimated taxes for the next tax year, as it were. So that hopefully, kind of helps understand that process rather than always making a payment just with the return each year. Okay. Moving on to Part 6A. Next slide, Harleen. Thank you. All right, so these are the activity questions. So we talked earlier about, the private foundation return really does tell the whole story of a private foundation. Not only does it have the income statement that Anand brought us through, or the balance sheet that Anand brought us through, and eventually it's going to have our grant lists and everything else, but it also asks a series of compliance questions about the activities of the foundation, and that's what this section does here in pretty in detail. So with that being said, just to go through these, this is really just updating the IRS and whether there's anything unique for the year or something that you're doing that's new, so on and so forth. The questions that you see here answered, they're the yes/no questions. I would say that what you see here for questions 1 through 10 is what the typical private foundation might look like, the plain vanilla foundation. Most of these being no with a couple of yeses, and we'll go through them one at a time. The political questions are first. We don't typically see those all too often, and again, that's just self-reporting based on what a foundation is doing. Really moving into line 2, this is really key. So line 2 talks about any new activities. As we've seen over time, we see a lot of foundations that are somewhat hybrid in nature. Maybe they're doing some new active programs or something that they didn't tell the IRS in their Form 1023. So for example, they filed their Form 1023 when the foundation was founded. They told the IRS they were going to be a grant-making organization, and now they're doing some active conduct of some sort of program. Or for example, to Anand's example earlier, perhaps art eventually finds its way into the foundation, is donated, and the foundation decides to have an art program and lends art to various museums and universities, etc. You would want to tell the IRS that you're doing something a little bit differently. International activities. So for example, if you never told the IRS you were going to do anything international in your 1023, but now you might start an international grant making program, you might want to tell the IRS that here as well. This covers just about everything that a private foundation might be doing that's different from what they had previously told the IRS. The only thing that you need to get express approval on in advance, and I shouldn't say the only thing, there's always different situations, but things like grants to individuals, or if you were going to start a scholarship program, those types of things really need pre-approval from the IRS on those separate processes to make sure that they're not biased, so on and so forth. So those are the types of things that do need to, you have to go through a different process with the IRS. But basically anything else that you're going to be doing as a foundation, you can kind of communicate to the IRS on this line 2 via a short narrative. Moving on to line 3, with regards to governing instruments. So again, anything that changes there, check yes, and you would attach a conformed copy of those particular changes. Moving on to line 4. I know earlier I said that this is the typical yes/no cadence that we see for most of our foundations, but clearly there are a number of foundations that do have unrelated business income or UBIT, as it were. We do see that with some of our foundations that have limited partnerships in their investment portfolio, so on and so forth. So again, if there's unrelated business gross income of $1,000 or more during the year, then clearly question 4A would be answered yes, and the organization would go and file Form 990T. In line with that, 4B would also be answered yes. We can't tell you how many times we are talking to a private foundation and we're looking at their Form 990PF, and these questions are both answered no, as you see here, but then they are actually still filing a 990T, which is appropriate because they have UBIT, but these answers are not yes. So that's just typically an error in preparation. Or the more grave situation is if these questions are answered no, and no 990T is being filed. But then when we start looking at K1s and looking at investments and the income derived from them, we do identify some UBIT, in which case that needs to be rectified. Okay. Moving on to line 5. This is where it's a question about liquidation, termination, dissolution, or a substantial contraction of the foundation. So clearly, foundations do sometimes get to the end of their life cycle, and there might be a liquidation, termination, dissolution, but I think the one that we see more often, or the one that we see that is most often overlooked, is the substantial contraction. So again, that substantial contraction is defined as total dispositions of the tax for the tax year, 25% of the fair market value of the net assets of the foundation at the beginning of the tax year. So what we see sometimes with smaller foundations, maybe with living donors, is sometimes maybe living donors, they give to the foundation makes big grants in one year, the donor doesn't give in the following year, the grant making kind of is a little wonky, and that foundation might kind of jump around from being a $1 million foundation to a $3 million foundation to a $1 million foundation again, and that would just need to be explained with regards to substantial contraction. And again, I think that we can usually explain that to the IRS in a very nice and succinct way, but it's important that we look out for that. Questions 6 and 7, these should basically, well, question 6 at least should always be yes. I think oftentimes this is just an error in preparation when this is answered as no, but it basically states that either your governing documents or the state in which you operate and under state law, that you're going to basically abide by all of the private foundation rules, such as you're not going to engage in self-dealing, you're not going to have jeopardizing investments, you're going to meet the 5% spend, so on and so forth. So when you answer that question no, that's kind of a shocker, because you're basically telling the IRS you're not going to follow any of the private foundation rules. Item 7 is typically answered yes, because most of the foundations, at least that we see, have $5,000 or more in assets. Line 8, this is the states listed. Sometimes we see some things overlooked here, whether you're a Delaware corp operating in New York State, those types of situations, you probably should have New York and Delaware there. And again, it depends on how many states, what you have going on. Some states can be more aggressive than others. For example, if you have like a single employee in California as a New York foundation, and you're filing a California payroll tax return, California might be talking to you about filing in California, that you have nexus in the state, and then that means California maybe should be listed here as well. Just one example there. And sometimes interacting with some of the states can be a little tough, whether it's the state of New Jersey or New York, whether you're on their radar, off their radar, where are you? You don't have a bricks and mortar foundation. You're operating with outsourced providers. What do you do there? All things to talk about with your preparer and make sure that the proper states are listed. And then it is a requirement by the federal government, by the IRS, that you furnish a copy of this 990-PF to the Attorney General or maybe the Secretary of State for certain states, and you just send that return to them each year. And again, that's a federal requirement that you send it to the State Attorney General for the state that you happen to be in. Okay. Line 9, really just for operating foundations. So if a foundation's already an operating foundation, they're going to always answer this question yes. Sometimes foundations, those switch. We've seen foundations become operating foundations. So if that happens, again, we would do something there, answer the question yes, and complete the appropriate part. Operating foundations, again, just a little bit outside the scope of today's session. And then lastly on this page, line 10, substantial contributor. So again, that term, substantial contributor, is an IRS defined term, but it basically means any person whose contributions or bequests during the current year and prior tax years total more than $5,000 and are more than 2% of the total contributions and bequests ever received by the foundation from its creation through the close of the tax year. So again, it's kind of a low bar, but something to be mindful of. Again, it's not really the end of the world, as it were, because that person just needs to be, they do need to be disclosed, they do need to be listed later on in the return. But one important takeaway is that once somebody becomes a substantial contributor, and again, we don't see this situation all too often, but if it was somebody who was not a board member, for example, but they became a substantial contributor because they gave so much to a particular foundation, They would actually become a disqualified person though, and kind of be treated in the same fashion as the board members or officers or key employees that you currently have that are considered disqualified persons. So then all those self-dealing rules that, again, we'll talk about later would apply to them as well. And again, that can catch some folks a little unawares because, they're like, well, that person doesn't have anything to do with the foundation. All they did was donate to us. But if they became a substantial contributor, they do become a DQ, a disqualified person, as it were. Can we go on to the next page, Harleen? Great, thank you so much. So continuing with part 6A, line 11, control. So this is basically the 51% rule. Sometimes maybe we'll see an organization, a private foundation that owns a foreign blocker corp. So they own 100% of an LLC that's used or utilized for the purposes of investing. Sometimes we see this with maybe side-by-side foundations. Sometimes there's a private foundation and a private operating foundation, both set up maybe by the same few trustees or few board members, and perhaps they even have some transactions between each other from time to time. So again, we would typically check the box yes and disclose that. The next question, we'll try to slow it down for this one. This one is one that we always talk about and gets a little bit more fanfare in the press, as it were. So line 12. And this asks the question, and this has been on here for quite some time, but it asks the question whether or not the foundation makes a distribution to a donor advised fund over which the foundation or a disqualified person had advisory privileges. If yes, attach the statement. So again, for this example, we have it checked as no, but for some foundations, they do make gifts to donor advised funds, and under current tax law, they certainly are able to do so. And under current tax law, the one thing that they're required to do is check this box yes, which is sometimes overlooked, and then describe the position that it still went to a 501c3 and name the name of the donor advised fund, et cetera, et cetera. The reason why we pause here and slow down is like Tom talked about earlier, over the years, we've seen different things that Congress or the IRS has focused on, et cetera. So, one of the things in recent years that we've seen is a little bit more focus on donor advised funds and then the interaction between private foundations and donor advised funds. So we had what was called the ACE Act, the Accelerating Charitable Efforts Act, which did not ultimately become law, but it went through the House as well as the Senate. And there were some interesting pieces of that. Again, outside the scope of this meeting, a lot of it was for donor advised funds and maybe some new rules around those, but there was also some accelerating incentives or rules around getting funds out of foundations a little bit quicker. But there is a piece or two of that ACE Act that is still in the Green Book. So under the current Green Book proposal, again, not law, but a contribution by a private foundation to a DAF would not be a qualifying distribution unless the sponsoring organization causes the contributed funds to be expended in a qualifying distribution by the end of the taxable year following that distribution, and the private foundation maintains adequate records to show that a qualifying distribution took place. And that donor advised fund cannot make another gift to another donor advised fund. That's in there as well. So again, just being really careful about that. So if a private foundation was in the business of giving to a donor advised fund for a variety of reasons, if this were to pass, it would put the responsibility on the private foundation to ensure that those funds ultimately went out further to a public charity within a year. So that's just one of the pieces of that for this particular line item that I wanted to highlight. So with that being said, moving on to line 13, did the foundation comply with public inspection requirements for its annual returns and exemption application? So, this should be marked as yes. As easy as it is nowadays with everything in the public forum, but it is still a rule. A private foundation must make its annual returns and the exemption application available for public inspection. A foundation can do that in a couple of ways, whether it's by office visit, by providing copies, or by internet posting. So again, We see some private foundations post their financial statements and their 990 PFs on their website. But if you were to ever get an inquiry, you would have to provide it to them. Another thing here is you also list your website. So the website address here is available. And then line 14, the books are in care of. This is just, another place where we want to make sure that, there's no home or personal addresses on the return as best we can, just to protect everybody. But again, disclosing where those books and records are. And again, when it comes to the phone number here, kind of going back to page 1 with the phone number as well, you want to make sure that the phone number is somebody who can really be a gatekeeper or a safeguard for the foundation and really not give up any unnecessary information, but can elevate inquiries to the proper folks at the foundation. Just something really important, and make sure that those people know what to do when they get an inquiry. However innocent or who knows what the impetus behind the question may be, you want to make sure that you have somebody that's able to handle that. Line 15, this is typically not applicable, kind of outside the scope for today. Line 16, we do see this quite a bit actually with some of our larger foundations or more exotic foundations, and this is about FBAR reporting. So this is about signatory authority over foreign bank accounts. So for example, if you're a foundation that maintains an office in London as well as New York, and you have a London bank account, for example, and the foundation owns that bank account, there would be a requirement to file this particular form. An important takeaway here is not only is it the organization's responsibility to file an FBAR, and it has its own timeline of IRS deadlines, so on and so forth, but it's also the individual's responsibility. So if the CFO or the president is the authorized signer on that particular bank account that's offshore, whether it's London, Cayman, wherever it may be, they too would have a personal FBAR that would need to be filed with their own individual tax preparer. And you would just want to make sure that they're aware of that requirement as well. Okay, moving into part 6B. We're going to pause there for a CPE question though, really quick. So before John goes through his whole section, we're going to talk about, do you feel comfortable with your knowledge around the self-dealing rules and regulations? I think one of the things that we usually joke about here is if you had 10 attorneys in the room looking at the same transaction, perhaps 5 of them would say that it is self-dealing, 5 of them would say it isn't, and John's going to be our tiebreaker today, so he'll let us know what is and isn't, but it's not always as cut and dry as people think it's going to be. So we'll keep that in mind. We'll just let this go to get up to over 70% voted, and then we will move on. All right, so we'll close that out. Great, and going on to the next slide. So I'm going to be brief on this page because I want to turn it over to John to really kind of go through those self-dealing rules. But again, this is maybe the typical yes/no cadence for a foundation that maybe has one paid employee or a series of paid employees, officers, board members, etc. So again, typically we don't see a lot of interactions between disqualified persons and foundations, but from time to time we certainly do. So again, mostly questions 1A1 and 2, we don't typically see those, but if we were, we would have to address them. Again, those talk about the sale or exchange or leasing a property with disqualified person. Again, John's really going to go into all of these. I'm going to focus on the yes, no's. What we typically see is items 3 and 4. Those typically are yes if you have someone that you pay compensation to. And again, they might be using a personal cell phone, and you might be, in theory, then accepting some goods from them, or anything that they're doing out of the goodness of their heart for the foundation, as it were, as well as disclosing the pay or reimbursement of expenses to a disqualified person. The most important thing there is, if for any of these questions, if any of them happens to be answered yes, is making the determination whether or not question 1B should be answered yes or no. And hopefully, most of the time it's being answered no. 1B, no. And basically that states that, yes, we pay somebody, but that act of paying them did not fail to qualify under the exceptions described in the regs, okay? If you do happen to answer question 1B yes, that's when you're in the penalty box. So again, we kind of look at this page, the 4720 page of the PF, talking about that as the penalty box return or the self-reporting return. This is an opportunity for foundations to be transparent and honest if they need to correct an act of self-dealing, even if it's an inadvertent one. Many foundations, even if they make a small mistake during the year, because mistakes happen, with people come problems and come mistakes, foundations are very transparent. They'll fix it. They'll do all the corrective actions, and this is the place to disclose all of that. Okay. Moving down to line 3, we'll fly along here a little bit. Sorry, line 2 rather. This is the failure to distribute income. Again, Tanya is going to talk about the 5% payout and how important that is. But basically, if a foundation were to miss that payout and were ultimately short and did not get out enough in the way of charitable disbursements in a given year, this is where you would check that box yes. And sadly, there's an initial tax of 30% on the amount. So if you were $100,000 short on your payout, you would have a $30,000 tax, and you would still have the $100,000 to get out the door. Again, unless you could have it abated due to reasonable cause, and again, we've been successful with that when there is reasonable cause. But again, sometimes these things roll over years. There's an additional tax of 100% if it's not corrected timely. So something important there to just be aware of. Lines 2A, B, and C, this just tracks all of the years, if there are multiple years, that an organization, a foundation, gets behind in its giving. Again, a little outside the scope for today. Going on to the next slide. Oh, sorry. Actually, we're going to stay on the slide. Lines 3A and B. Excess business holding. So we've seen 20-page PowerPoints and 30-minute presentations just on excess business holdings. We think it's a little bit beyond the scope for today, but an important thing is just to kind of be aware of it. So it's really just asking the question, did you have any holdings over 2% ownership? And again, those excess business holdings of a foundation, private foundation is generally permitted to hold up to 20% of the voting stock of a corporation. But again, there's a lot of questions here. And sometimes we see this when certain things are donated to a foundation. And generally, a private foundation has about 90 days to dispose of an excess business holding acquired other than by purchase. But again, very important to kind of know what's going on there. And if it is donated, you have up to 5 years to ultimately, actually completely dispose of the asset. And you can ask the IRS for permission for an additional 5-year period. But again, this is all very complex, something that we work on typically with the attorneys, with the foundation, and we look at every situation, uniquely. Okay, and I guess the so what on that is the excess business holding taxes. There's an initial tax of 10% on the value of the excess business holding. And again, if that excess business holding isn't disposed of during the taxable period, it could be an additional 200% tax. So again, very steep ones there. Lines 4A and B, the jeopardizing investments, always a fun topic. Almost 100% of the time, this is no. We don't see this very often. I think that there could be arguments to be made that if a foundation had 100% of its assets in Bitcoin, would that be considered a jeopardizing investment? I think the IRS might think so. But again, those are the types of things, just heavy concentrations, anything that's very risky, anything that would jeopardize the foundation's ability to continue its mission, as it were. All right, next slide. Prior slide. Prior slide, Harley. Thanks. So then, just to wrap this up, again, more questions about yes, no. Do you do any of these things? Carry on propaganda, influence the outcome of an election. Those are the political questions. We typically see those answered no. Always have to be careful as a foundation. Sometimes we see question 3 here, provide a grant to an individual. Sometimes we see that as yes. Very simply, if you have a scholarship program or individual grant program, you answer that yes. And the other one that we see quite often is question 4, which you actually see on this sample return, that is yes. And that's providing a grant to an organization other than a public charity, as it were. So if a private foundation gives a grant to another private foundation or to a for-profit entity, then it needs to follow what's called expenditure responsibility. And those following questions, moving down 5C, 5D, 5D asking about, what did you do for expenditure responsibility? How did you report on that? Very important to close out each of those grants. And then quickly, once again, kind of similar to the prior page, line 5B, if any answer is yes, did any of the transactions fail to qualify? And again, hopefully we're able to answer that as no. None of them failed to qualify under the exceptions in the regs, and none of them are deemed a taxable transaction or something that would require a Form 4720. Okay. Moving down to 6A and B, we don't typically see these too often anymore. I think that those are a little bit more from yesteryear. Line 7A, B, don't typically see any tax shelter transactions. And then line 8, relatively new, excess comp on $1 million or more. So just as a reminder, there's a 21% tax on comp over $1 million. So if you're trying to pay $1.1 million in comp, and that's combined with deferred comp that vests maybe, that $100,000 of excess comp is subject to $21,000 in tax that's due, and that gets paid on Form 4720. Okay, so that's relatively new, and Anon might talk about that a little bit when he is going over the compensation disclosure pages. So with that being said, I'm going to turn it over to John Tyler. Thanks for keeping up with me throughout all that, and I know we have a lot of questions in the chat. We'll pick a few and go through some of those later on, or get back to you later. But John, turning it over to you. Thanks.
Thank you, Joe, and thank you, Tom, for your kind words in the introduction. We're going to go through the self-dealing aspects of it in a little more detail, in part because they're not necessarily common sense. Let's go to the next slide. They're not necessarily common sense because they are a term of art. So for the next few minutes, these are the things we're going to cover. I'm going to provide some context for what is self-dealing, and why it matters in some cases, mostly for compliance, but for things beyond compliance as well. How you can identify self-dealing, the definitions, what's prohibited, also exceptions, penalties, and then coming back around to the key questions that help you identify if you've had a self-dealing transaction, but more specifically, how to avoid having a self-dealing transaction. So next slide. So some of the context, and Tom already talked about this, the self-dealing provisions came about in the Tax Act of 1969. And I won't go into the why. The key aspect for the context is that the self-dealing provisions apply to private foundations. These don't apply to public charities. So there is a compliance difference, and arguably even slipping into degrees of an ethical regulatory interest that is, or an approach that is different for private foundations than for public charities. And also, self-dealing is a term of art. It's a term of art. It's defined in the statute. It's defined in the regulations. It's different from conflicts of interest because it is so explicitly defined. Conflicts of interest is going to be a larger category. Self-dealing transactions are likely to also be, or potential self-dealing transactions, even if they fall under an exception, are still likely to be conflicts of interest transactions that you would still need to pay attention to and manage through with the conflict of interest policy, and how those aspects are governed and managed. Next slide. So as I said, self-dealing is defined in the statutes and in the regulations. It prohibits, and it's in some ways, unless an exception applies, it prohibits certain very discreetly listed and specifically described transactions. If it's not listed or described, it's not going to be self-dealing. May still fall under conflict of interest policies, may still fall under other things, but it's not going to be self-dealing from a compliance standpoint. So it prohibits certain transactions between private foundations and their disqualified persons. And we'll talk about disqualified persons in a minute. And Joe sort of introduced us to that term in talking about excess business holdings as well. Whether direct or indirect. And that's an important thing to understand, because a private foundation can't enter a transaction directly with a disqualified person. It also can't do it indirectly. So it can't use a third-party intermediary, for instance, so the foundation enters a transaction with a third party enters a transaction with a disqualified person. That could be problematic, especially if it's orchestrated, but could be problematic if it's even not orchestrated. So it's both direct and indirect. So let's dig into the definitions a little bit more. Next slide, please. Thank you, Arlene. In order to look at self-dealing, when you look back at the statute, there are three key questions. Does the proposed transaction involve a disqualified person? If it doesn't, then whether it's listed or not doesn't matter. If it doesn't involve a disqualified person, it's not self-dealing. Is the transaction listed? So if the transaction involves a disqualified person, if it's listed, then you go to the third question, which is, does an exception apply? So if the transaction is with a disqualified person and the transaction is specifically listed in the statute of regulations and an exception does not apply, don't do the transaction. It's going to be self-dealing, and you're going to have reporting and correcting and all those sorts of things. If an exception does apply, that means you may still report it. Well, you probably will still need to disclose that there were the transactions, and like Joe said, answer the question: does an exception apply? Check the box yes, and in an audit situation, you'll have to provide the details. But if an exception applies, the transaction can move forward from a self-dealing standpoint. You still may separately need to manage through the conflict of interest processes and practices that exist as well. Next slide, please. So, disqualified person. These are the categories of disqualified persons as defined under the statutes and regulations. And essentially, the all caps underlined bolded words are sort of categories of thinking about disqualified person. People with authority to make decisions on behalf of the foundation. Officers, directors, trustees. Now, trustees can be an interesting category because technically, as a governance matter, trustees individually don't make decisions. They act collectively as a body. But individually, as trustees, they are considered disqualified persons without regard to their ability to act individually. So do they have authority to act on behalf of the foundation? Substantial contributors, and Joe mentioned that earlier. And these the definition of disqualified persons is the IRS wants to make sure that people aren't abusing the foundation. Insiders are not abusing the foundation. Insiders are not taking advantage of the foundation. And the foundation is vigilant to pursuing its charitable outcomes. And another part of the unusual definition of disqualified persons is the family members. So it's not just the officers, directors, trustees, substantial contributors, but it would be their spouses, their parents, their grandparents, their great-grandparents, their children, grandchildren, great-grandchildren, and their spouses as well. So it goes to some length to identify the potential for indirect or temptations towards indirect transactions by specifically calling out these people are disqualified persons themselves directly under the definition of disqualified persons. Entities controlled by disqualified persons. Again, this is a way of looking at the potential for indirect and calling out that indirect can't be done because the entities controlled by disqualified persons are in fact disqualified persons. And then certain government officials under certain circumstances. Next slide, please. So then this is the list of transactions, and we saw a version of this when Joe was walking through the tax return in Part 6B. And what we're going to do, I'm going to go through each of these, but in the context of also discussing the exception. So remember, the three questions are: does a transaction involve a disqualified person? If yes, is the transaction listed? If yes, then does an exception apply? So these things should be taken together, and that's what I'm going to propose to do here in more detail with the next few slides. So we'll go through each of these next. Next slide. So sale, exchange, or lease of property. Does the transaction involve either the foundation buying, exchanging, or leasing property from the disqualified person, or the reverse, the disqualified person buying or exchanging or leasing property from the foundation. These transactions all presume an exchange of money. So I mean, a common example here is if you've got a board member who's a board member of a public charity, and they've got office space and they've got some vacant space and they want to make it available to the public charity, it's going to be subject to conflict of interest policies, hopefully, but it's not a self-dealing transaction because it involves a public charity. If you get the same transaction, but it's a board member of the private foundation, and they've got space and they want to make it available to the to the foundation, that's a self-dealing transaction by definition. The exception would be the board member or the disqualified person, in this case the board member, making the space available at no charge to the foundation. Not even necessarily charging for the square footage allocation of utilities. That, even though it's arguably a break-even transaction and the foundation's still getting a great deal, doesn't matter. As the IRS looks at self-dealing transactions, the fact that the foundation is getting a great economic deal does not matter. There is no de minimis exception. There is no overwhelming benefit exception for any of these for the foundation. Now, if it's no charge to the foundation, then the foundation can be in that space. In that case, the foundation ought to contract directly with the utilities, to pay the utilities as much as possible. The flip side of extraordinary benefit, the foundation leasing property to a disqualified person, and the disqualified person paying 100 times the fair market value, foundation gets a wonderful, extraordinary benefit. It's still a self-dealing transaction. It's still going to be a problem. It's still going to have to be unwound. There's still going to be the penalties. So the exception is no charge to the foundation. Next slide, please. So furnishing or receiving goods or services, an exception to that. Now, this is not in the goods space. Reasonable compensation for employment, that's actually covered under C as well. That there can be, if the foundation is operating programs, so delivering services into the community, and it makes those services available as part of its programming, its charitable programming, its charitable activities, and anybody in the community can participate. Disqualified persons can still participate, in those activities. An example that I would give: the Kauffman Foundation operates 1 million cups, programs around the country, especially here in Kansas City. If my children want to go to the 1 million cups program, they can. they can benefit that because it's available to the general public, and my children are not taking advantage of it in any other way than is available to the general public, and it's a charitable program. But otherwise, furnishing or receiving goods, that there's not an exception on the goods side of things. So a disqualified person who owns an office supply store, saying to the foundation, hey, I'll sell you your office supplies at cost. And normally there's an X multiplier markup, but I'll provide them at cost. Well, that's actually now a self-dealing transaction. There's no exception for that. And even the second bullet under exception, donate to the foundation for its charitable purposes. The goods being donated, the goods being given without cost, a la the sale, exchange, lease of property or lease of property example. If the office supply store is not charging anything, the disqualified person's store can donate the goods to the foundation for its charitable purposes. Next slide, please. So C, lending money or extending credit. Credit, one way or the other, is not a good thing unless the credit is being extended by the disqualified person to the foundation for its charitable purpose, and there's no fees, there's no interest, there's no penalties. It's just a loan, and even looking at return of the principal, but no interest charges, no fees can be associated with that. And certainly the foundation cannot extend credit to disqualified persons. A common issue that comes up is, well, what about especially staff very often have credit cards, and what happens if a disqualified person on staff accidentally uses the card, the foundation card, to put gas in their car or at a restaurant, or make some other purchase, and it's clearly an accident. Identify the accident as soon as possible, bring it forward, make sure that the foundation is paid. And this is one of those, Joe mentioned looking at the same facts, and there could be 5, 10 lawyers, maybe 10 accountants, 5 different opinions on each side of this. One of the ways to approach credit cards is to try to fix the transaction before the bill has to get paid, the credit card bill, because there's some argument that can be made that the credit hasn't actually been extended on the mistaken purchase until the bill is paid. But identify it quickly. Disqualified persons should be looking quickly, and acting quickly. Something that some foundations do is they for disqualified persons with credit cards, they set up accounts. Maybe there's $100, $500 in the account, and if there's an inadvertent mistaken charge, a personal charge on the card, the money's there and it's drawn down, and the money sits in the foundation. Again, it's not a loan. It's advanced coverage for a mistake like that. Next slide, please. Reasonable compensation for personal services. Here, and this ties back to what I said a minute ago on B with compensation for services. Disqualified persons can provide services. I'm a disqualified person for the Kauffman Foundation. I'm employed. I do get paid. I have bills and children, and I do get paid. And but the payments have to be reasonable, and in the employment context, reasonable, and really in furtherance of the charitable operations of the foundation. And that, the foundation can still have an investment staff who it's paying, but it's got to, from a payout requirement, treats those that compensation differently. And again, that's got to be reasonable. A foundation can contract with disqualified persons to provide the quote unquote personal services, which is very often really more looked at in the context of professional services. So oftentimes, especially with smaller foundations, a foundation's lawyer might serve on the board. They're a disqualified person by virtue of their board service, but they are still the foundation's outside counsel, or an accountant will often do that as well. And those arrangements are not self-dealing as long as the compensation is reasonable and in furtherance of serving the foundation's charitable purposes. Compensating board members is not self-dealing as long as compensation is reasonable. Reimbursing expenses is not self-dealing. The foundation providing D&O insurance premiums is also considered an exception to the self-dealing rules. Next slide, please. The transfer, use of foundation income or assets by a disqualified person. So a lot of times, when I look at this language without explanation, I can't help but wonder what it means. And so jumping down to some of the common issues, for instance, if the foundation buys a table at a charity event and it needs to fill that table, oftentimes disqualified persons are invited to fill those seats, as might other staff folks as well, or other volunteers at the foundation. They often ask, well, can I bring my spouse or significant other or a business associate or a good friend? There can be a legitimate rationale for the disqualified person to attend the event and for the foundation to pay the cost for the disqualified person to attend the event. But unless there's a separate business, if you will, and by business I mean the foundation's business rationale for a spouse or friend or business partner to attend, that is not something that would be a transfer use of foundation income or assets by the disqualified person. They're using the table ticket to have their spouse or friend with them at the event, which does not serve the foundation's charitable purposes. Now, if their spouse happens to be a disqualified person as well, they're attending as a disqualified person, not as a spouse. Travel, if there are board meetings or site visits that involve travel, that can also create problems here. In some cases, another common issue will be related to the exception, a disqualified person making charitable pledge and having the foundation pay it. That's a misuse of the foundation's assets and falls under the definition of self-dealing. The foundation matching a pledge, though, is not necessarily self-dealing. So if I pledge $100 to a charity, I write a check for the $100, the foundation matches it, let's say 2 for 1, so the foundation's going to put in $200. That match is not self-dealing. If my pledge is $300, though, and I'm only paying $100 and the foundation is paying $200, that's going to be self-dealing, because that's the foundation paying my pledge, not just providing a match to my pledge and what I pay. Now, one of the exceptions in the matching context, there's oftentimes some naming or some public recognition that can exist, and that's what it means by benefits are incidental and tenuous. They're and naming, public recognition. Naming is going to be a problem, but public recognition. Thank you to John for his contribution, and hopefully what they're saying is in the foundation for its match. as opposed to putting me up into a higher category, including the foundation's match. But naming, or I'm sorry, public recognition is something that's incidental and tenuous and is doable. You know, the statute regulations and IRS application of them don't necessarily go too deep on that unless it's beyond incidental and tenuous, and you know, actually long-term naming rights of, for instance, on a building or something like that, is more likely to be considered fulfilling a pledge rather than a mere foundation match. Next slide, please. Don't want to spend much time on this one because who counts as a government official is its own question, and it has its own nuances to it. Just keep in mind, if you're entering a transaction with a government official, somebody who is a government official, you should look up the definition of government official, work with outside counsel, work with your accountant to identify, are they a government official, and can you actually make the payment? Can you engage them as you know, as a consultant? The answer may be no, because they're a government official. There's an exception if you're contracting with a government official for employment. That's and the engagement is within the last 90 days of their government service, and you can also reimburse certain expenses for a government official attending a charitable event, you know, with you in the United States. One of the things on reimbursement of expenses, beware of government ethics rules and government reporting rules that the government official is going to have to be bound by and have to be paying attention to. It helps if you're also aware of those and paying attention to those for them as well. Next slide, please. So penalties, similar to what Joe mentioned earlier, there's 10% penalty on the front end if you, for the disqualified person. If it doesn't get fixed, it increases to 200% for the disqualified person. You know, Joe mentioned this in a different context. This is fairly consistent pattern with some of the penalties for violating the private foundation rules. One of the key things to remember here, though, is that with self-dealing and violating the self-dealing rules, the disqualified person who's at the center of the transaction, or persons who's at the center of the transaction, is paying personal. They're paying these excise taxes personally. Foundation managers who approve of the disqualifying, who approve of the self-dealing transaction, also incur personal liability. You know, up to, you know, for 5% of the transaction, up to $20,000. So these you know, the Congress wanted disqualified persons to have some skin in the game, if you will, you know, with regard to self-dealing, and to pay attention to it, thinking that that not wanting to pay penalties oneself is an extra bonus beyond just wanting to properly steward the assets of the foundation. It's important to recognize too that that it's not just if there's a self-dealing transaction, the penalties, if you will, the consequences aren't just from a compliance standpoint. There could be reputational consequences as well. Remember, the tax return's a public document, and if there's a self-dealing transaction, the obligation is to check the correct box saying yes there is, or no, an exception doesn't apply. Was there a transaction in prior years? If the answer is yes, you got to check yes, and then provide descriptions of the remedies, the cure, the steps taken, etc. So you know there can be some reputational issues associated with you know, for the foundation and the individuals with self-dealing, and there's also costs to remedy. You know, dealing with the IRS, dealing with the processes, the steps of fixing. Let's even assume it's a mistake, because by the way, intent doesn't matter with self-dealing. Self-dealing can just be a mistake, a simple thing that happens that people didn't think about, weren't aware of, forgot about. Doesn't matter. It's a self-dealing transaction. You know, intent doesn't I didn't intend to, is not a defense to a self-dealing transaction. So then there's cost to remedy. And by the way, I would venture to guess that most self-dealing violations are not intentional. They are accidental. So being able to go through this and have your antenna up to be able to ask questions and get information, I think is a great service from PKF et al. Next slide, please. So going back to the questions, does a transaction involve a disqualified person? We've talked about who that is. Is it listed, and are there exceptions? We've gone through the list of the transactions and exceptions, all of them at a very high level. And those can often be nuanced. The idea is that your antenna are informed and you're up. And when you look at transactions that that could involve an insider, especially in thinking more broadly, make sure you go beyond conflict of interest management and make sure you're paying attention to these three questions. Is it a self-dealing transaction? Next slide. And Tom, thank you for inviting me to be part of this. I will stick around for questions. I provided contact information here, not so I can be anybody's lawyer. I can't, but I'm happy to be a sounding board if it would make sense at some point later on.
Thank you, John. That was very informative. Thank you for joining us. Harleen, you mind going? Perfect. Our next slide. I'm going to spend a few minutes on part 7 of the 990 PF. Part 7 is broken into 3 different sections. One, the first is where a foundation is required to list its officers, directors, trustees, foundation managers, not only their names and addresses, as you see here in column A, but also their title, their average hour per week that is devoted to that position. Also, there's a requirement that compensation be disclosed here. Any contribution to any employee benefit plan, whether it's a 401k plan or defined benefit plan. And as you see here in column E, if there's an expense account or some other allowance type of account, it needs to be disclosed. I think the most important thing I want to touch on here is, again, going back to the addresses. A lot of times we see their individuals' personal addresses. Again, that is a no-no. You make sure you include the foundation's address or care of the foundation. A few other items here I'd like to touch on. Obviously here, for example, Mary Smith, the first individual listed here, is the president. At times, an individual may have multiple titles, so it can be president/trustee. Again, it's important to make sure we have the proper titles. The time devoted is also another area I think that is very important. At times we see that is left blank, or even 0 is left there, or 0.2 hours. Obviously, doesn't really make sense. You want to make sure these individuals who are on the board are spending the time. Again, but an hour a week I think is reasonable. But when stuff is 0, again, it becomes questionable. Further down, we also have the executive director is included in here as well, because they are considered officers and directors. They fall in the same category. Nothing out of ordinary here. I think what we look for sometimes when we pick up a new 990 PF or a new private foundation is to make sure that the hours reflect the compensation and vice versa. Here we have 40 hours per week at $185,000. That is a reasonable amount. If it was 10 hours a week at 185, then again, that may raise a red flag, and excess. Somebody may feel like that's an excess compensation. But again, these are things that you want to be aware of. Also important on this part, regardless of compensation, anybody that falls into this category needs to be listed. Which takes us into part 2, the compensation of the 5 highest paid employees. Just take a step back. Back I would say 10 or 12 years ago, the IRS revamped the 990, and the thought was to also revamp the 990 PF. But the IRS ran out of money for that specific project, so the IRS ultimately did not revamp the 990 PF. Why do I say this? Why do I bring this up? The 990 series also requires the same disclosure. However, the threshold for an employee to be listed here is $100,000 or more, where here the PF is still the old threshold of $50,000 or more of compensation. So similar to the table above, you would list their compensation, of course, the hours devoted per week, their title, and if it's more than 5 individuals that make in excess of $50,000, you would list the top 5, and on the right-hand corner where it says 0 here, you would indicate the number of individuals that do exceed that $50,000. Again, just the number. Moving to the next slide. So this is again similar to the employees. Here is where you're required to disclose independent contractors that make in excess of $50,000. Again, the name of the entity, their address, but also the type of services that is provided and the compensation. Very important. Normally for private foundations, what you see there is going to be investment management fees, some legal fees, some consultants, but again, similar. If anybody, it's really independent contractors, you list the top 5, anybody above that, or if it's more than 5, you include that in the box on the right-hand side. Next slide. Thank you, Harleen. Takes us to our next CPE question. Does your foundation have direct charitable activities or give out any program-related investments? Yes or no? Thank you, Harleen. So that question really segues us into the next part, which is part 8 of the 990 PF. When we talk about DCA or direct charitable activities, generally speaking, what do foundations do? They make grants and give out grants, and that is considered an indirect expense. Although you're making it, a grant to a public charity, it's still considered indirect. DCA, generally speaking, is when a foundation is significantly involved in a program, in the expenditure. More and more we see now private foundations working with their grantees, putting on workshops, seminars, so that or doing research or conferences. That's where DCA comes in. So the foundation is directly involved in meeting that mission. This section, again, if the foundation if it's not complete, it doesn't mean it's wrong. Again, this is a section that mostly completed by operating foundation, but it is a marketing tool for grant-making foundations that go above and beyond the grant-making process and provide these type of services and put on these type of programs. Here, the IRS requires that you include any relevant statistical information, the number of organizations that you serve, the beneficiaries that are served. So again, you really put a little, again, it's more of a marketing tool informing everyone what the foundation does in addition to its grant-making activities. Move on to our next slide. Thank you, Harleen. So program-related investments, and many foundations are now using this tool or this vehicle to in short really just provide access of capital to its grantees. It's a way where foundations can provide capital at low cost. PRIs are really 2 types of PRIs. There is a loan PRI. That's where a foundation provides a loan to an entity. The loan, generally speaking, is below market. The interest on the loan is below market. That's what makes it a PRI. Also, there's equity PRIs, where again, it's almost as an equity investment, but ultimately it's a lower cost than a traditional investment or a traditional loan. Important about PRIs, and Tanya will touch on in the next few slides, when a foundation does make a PRI, the PRI counts, the dollar amounts count as qualifying distributions in the year it is made. However, when that principal is returned in a form of repayment or return of capital, it works against the qualifying distributions in the year it comes in. Here, the IRS requires that you disclose the 2 largest PRIs. And if there are more than 2, the next section, part 3, is where you elaborate on the remaining PRIs that are, again, don't belong in the top 2. Next slide. Thank you, Harleen. Tanya, you want to take over from here? And just, I'll do this one quick polling question. What type of private foundation is your organization? Non-operating, operating, or other? Thank you, Arlene. Tanya? Tanya, you're on mute.
Thank you, Anand. I hope everyone's been enjoying the presentation thus far. The next few slides are going to be an accountant's dream because they're full of numbers and calculations. So in this part right here, this is where we calculate that 5% that needs to be given out. As Anand mentioned, private foundations are required to give out 5% of their assets. Now, what is considered an asset? This is anything that is not used for charitable purpose. So typically your investments. So line 1A, we include here the average monthly fair value of your investments. Now, you can calculate the average by using, typically they use the closeout price on a daily basis. If you have a custodian statement, typically they just use the monthly averages provided on these custodian statements. Line 1B is the average of monthly cash balances. In order to calculate the average cash balances, you take the beginning of the month, the ending of the month, and average that out. Line 1C, these are the fair value of all other assets. Now, this is typically your real estate, your royalties, and other less liquid assets. These are valued annually, except for real estate that can be valued every 5 years. So then we add up those numbers. In this example, we come up with 25 million. Now there is a line 1E, a reduction claim for blockage and other factors. We typically see this line completed for artists, endowed foundations for the blockage of the artwork. And then we get to a number of 25 million. Now the IRS is kind enough to allow us to deduct 1.5% of that, which they deem to be for administrative uses. And then we take 5% of that 24 million, which is 1.2 million. Now this 1.2 million is the 5% that you are required to give out. Move on to the next slide. Okay. Well, now we know what we have to give out. This next part is where we discuss, well, okay, let's figure out how much we did give out. So we take the minimum actually, there are some adjustments to the amount that we have to give out. So we start off with that 1.2 million that we calculated on the previous slide. The IRS allows us to also deduct the taxes that we paid. If you were to have any UBIT tax, that would be on line 2B. Okay, then PRIs. So anytime a PRI is given out, you get the benefit of giving out that as a qualifying distribution. If you get the PRI back, you have to add that back, which increases your required distribution. So in this case, a PRI was returned, increasing the required amount this year, bringing us to a total of 1.6 million. So that is what we are supposed to be giving out this year. Moving on to the next slide. Okay, so now we know what we have to give out. We've made all the adjustments. Now let's figure out what we did give out. So Anand took us through that 2.1 million that is found on line 1A. This is the number that was on your page 1, column D total. And then we make some adjustments to this. The foundation also gave out a PRI. This PRI also counts towards your qualifying distributions. Line 2. So if you purchase an asset, some furniture, some equipment, we don't depreciation is not allowed in column D. And the reason why is because you are allowed to take the full benefit the year that you actually purchase the asset. So the full amount of the asset counts towards your qualifying distribution. If you have any set-asides, this typically requires prior authorization from the IRS, but this would also increase your qualifying distribution, bringing us to the total amount that is eligible to be considered qualifying distributions, which in this case is $3.1 million. Moving on to the next slide. Well, where does it now? This page is where it all comes together. So line 1, column D, this is the amount that we were required to pay out, which totaled $1.6 million. Line 2A, let's say that we had any amount that was undistributed from prior years, that would be in column C, line 2. Now the IRS allows you until the end of your tax year to meet your required minimum distribution payout. And the reason why I say tax year is if you were to change your year end or make it smaller, you don't have 12 months to meet your distribution, you have until the end of that tax year. Line 2B, if you had undistributed income prior to 2021, that would be included here. A reminder, as Joe mentioned, this amount is subject to that 30% excise tax. Line 3, A through E, if you had any excess distributions, what does that mean? That means that you went above and beyond giving out your required amount. You are allowed to carry that forward. So on this page, we will see that there were carry forwards from prior years totaling $1.9 million. Okay. Line 4, this is a number that we just calculated on the prior page. This was your total qualifying distributions for the year. Now, let's say that you didn't meet your prior year distribution. What happens is the qualifying distributions that you made this year first get applied to the prior year amount. In this case, had there been a number, it would have been in line 4A, column C. And then the remaining would go and satisfy the current year distribution. In this case, it is 0 because this foundation in particular actually gave more than they needed to. Okay. So on line 4E, that 1.4 million, the foundation was required to give out 1.6. They gave out 3.1, which means that they gave out 1.4 million in excess this year. Moving on to the next slide. So here we have the excess. As I mentioned before, you are allowed to carry over any excess that was made. So if we look at line 10 here, we had excess from 2018 of 40,000, 2019 of 1.1 million, and so on. These get carried forward every 5 years. Now, a question that I always receive from our clients is, well, we want to use our excess, just use our excess and then apply what we gave out this year. Well, we can't do that. So, if you're budgeting and trying to use that excess, it's important to consider that in your budget if you're trying to use it, because if you don't use it, you lose it. Okay. Moving on to the next slide. So this part would only apply if you are a private operating foundation. So a non-operating foundation would not complete this part because they complete the prior part that we just went over. Next slide. Well, now let's say that you are a private operating foundation. So to qualify as an operating foundation, the foundation must make qualifying distributions directly for the active conduct of at least 85% of the lesser of your adjusted net income or your minimum investment return. Now, this test is known as the income test. Next slide. Now, foundations are required to meet the income test. In addition to the income test, they are required to meet one of the following: the asset test, which means that more than 65% of your assets are used for charitable purpose. So typically, if you are a private operating foundation that's a museum, you would pass the asset test. The endowment test means that you gave out in qualifying distributions for a direct act of conduct of more than 2/3 of your minimum investment return. Then lastly, the support test. Support test means that you received more than 85% of your support from the general public. That also has to include more than 5 different donors. So it couldn't be just from one donor. Moving on to the next slide. So we'll now walk this through page 1 for a non-operating foundation. It is different for a private operating foundation, as private operating foundations do complete column C. So what goes in column C? So column C includes your interest, your dividends, short-term gains only. So column A had both, column B had both, column C is only short-term gains. And then any income from charitable functions. This could be if you host any classes, so if you have any income from workshops or classes, that would be included in column C. Moving on to the next slide. Okay. Also in column C are the expenses. What type of expenses go in column C? These are the expenses that they're derived where the income derives from. So you have your investment expenses, as well as the consulting expenses or any other expenses that generated that income in column C. So if you had to pay any teachers for hosting the classes, that would also go in column C. On line 27C, there is our adjusted net income. Now we want to keep this number in mind because this is one of the numbers that is used in order for us to pass the income test that is required by private operating foundations. Keep in mind, this number can never go below 0. If it goes below 0, any expenses over go into column D. So this is either 0 or there is a positive number. Moving on to the next slide. Now this is where we see it all come together. So line 2A, that 549, this is the adjusted net income from page 1. Now, 2 numbers could have gone here. It would either be the adjusted net income or the minimum investment return. We always choose the lesser of, which in this case, the lesser of was the adjusted net income totaling $549,000. So how do we meet the income test? By giving out 85% or more of that. So 85% of the 549 is 467,000. We made qualifying distributions totaling 3.1 million, which could be found on line C. Now, for private operating foundations, these distributions have to be for direct conduct, so you have to be invested. So what happens on line 2D is we back out anything that was not for the direct active conduct, which in this case were grants paid. So line 2C has a total amount of qualifying distributions. 2D, where we deduct what wasn't, leaving us with a total on 2E of the amount of distributions that were made directly for the active conduct of exempt activities. So let's look at line 2B again. We were supposed to give out 467, we gave out 3 million, we passed the income test with flying colors. Now that we've passed the income test, we have to pass one of the other 3. Now this particular case, there weren't any assets held for charitable use, so they don't pass the asset test. They also didn't receive any contributions, so they weren't going to meet the support test. So what we do is we calculate the endowment test. So in order to pass the endowment test, your qualifying distributions had to be more than 2/3 of your net investment return, minimum investment return. So the minimum investment return that we calculated was 1.2 million. 2/3 of that is 831,000. We gave out 3 million in qualifying distributions. We only had to give out 831. We also passed the endowment test with flying colors. Now, you may be wondering, well, what happens if we don't? Well, you actually have to pass the test in 3 of the 4 years, or pass the test in total of the 4 years. So there is some leniency when it comes to passing the private operating foundation test. Okay. Next slide. Okay. And with that, I will pass it over to Eric.
Thank you, Tanya. Welcome everyone again. Thank you for staying with us. I'll be covering part 14 here, which is the beginning of your supplementary information, the 990 PF. First questions here, looking for information regarding the foundation managers, specifically related to concentrations. 1A is looking for any foundation managers that have contributed more than 2% of your contributions received during the year. This is where you'll list the names of these individuals. And similarly, another concentration where perhaps the foundation is invested in a particular investment that consists of more than 10% of their portfolio, where a manager of the foundation is also invested. So disclosures for that manager. Number 2 here, looking for information on the grant making program of the foundation. If the foundation is open and soliciting to receiving grants throughout the year from recipients, they would provide their address and information here, the website, the telephone number. This box is unchecked and you see the address and information compiled here before you. Some cases this box is checked. Typically we might see, your family foundation where they don't want to disclose any of this information and they pre-select their grant recipients during the year. In addition, you might not find on their website any contact information, likely because they're pre-selecting their grants throughout the year. Next slide, please, Harleen. Okay. CPE question number 8 here. Does your private foundation make any grants to non-public charities or foreign grants? It's a good preface to our next section in the supplementary information. One of the most important sections in the 990 PF, which discloses all of the grants that are paid during the year. Okay. Thank you, Arlene. So again, part 14 still in supplementary information here, grants and contributions paid during the year. First and foremost, this first section here is on your cash basis, right? So only cash made and paid during the year to grant recipients. Okay, so this total line here would agree back to your part 1A. In this case, this foundation is on a modified cash basis, again, as it was disclosed in part 1. So here, paid during the year, you would list every single grant that is paid during the year. You'd list the name of the grantee, and especially the address of each of the grant recipients. Third column there, the tax status and the code is critical here, disclosing whether the grant recipient is first a PC or a public charity, a 501c3 organization, or in this case, as it's pointing out here, NC are not classified. Perhaps it is a for-profit organization or an organization that requires expenditure responsibility. Expenditure responsibility disclosures here on statement 12 would allow you to compile the additional information needed, disclosing the reporting and monitoring procedures required for expenditure responsibility grants, expanding on the purpose of the grant and how it's achieving the charitable purpose of the foundation. And again, if you had any approved grants for future payments, it's not necessarily a function of you know, a U.S. GAAP accrual basis versus cash basis. Those grants that are approved for future payments, if it's a multi-year grant, would be disclosed here in section B of this page. Next slide, please, Harleen. Okay, part 15, the analysis of the income producing activities. So this page here should look pretty familiar to, again, part 1. The only difference here really is the addition of the columns for UBI, unrelated business income. So as well as the fact that you would not be reporting any support or contributions received by the foundation during the year. So this form here would really be, the purpose is to serve the classification of the income and disclosing any UBI that is received, any components of the various revenue streams and such on the left-hand side. You'd be disclosing your UBI after the analysis is performed. Again, this would indicate whether a 990T would be required to be filed as well for the foundation. Further to the right, you would disclose anything related, any revenue received from, you know, a programmatic related function. So any revenue earned from the foundation, then their exempt function. In this case, PRI related interest was received for $2,500. Anything compiled in this column, as we'll see in the next slide in a moment, would require further disclosure in the nature of that revenue earned, and then you would report on how it meets the programmatic mission of the foundation. And again, just total line here, line 13, the 3.9 million would also agree back to your part 1 in total. Next slide, Harleen, please. Okay, again, here's the additional disclosure regarding that PRI interest, in which case this was to support expanding, improving the affordable healthcare programs, and indicates that it was a loan that was made to the organization. And next slide, thank you, Harleen. Part 16 is the last piece here, really, of your supplementary information. Information regarding transfers of assets to 501c organizations that are not 501c3 or public charities. Okay, so IRS is looking here for disclosures of information when a foundation is transferring cash to, typically you would see a 501c7, your social club or your membership organization. Oftentimes we'll see the Rotary Club. They want disclosures of anything that's transferred to a non-501c3 organization here. If any box is checked yes here, you'll work through the answers here and indicating the nature of the asset that was transferred, whether it was cash or securities. Perhaps it was services rendered. You would then be required to disclose that further below here, below the table here, and just disclose the fair value of the assets that were transferred. Another instance that we've seen very common is the 501c2, the title company, where there might be a wholly owned subsidiary where cash is transferred for the reimbursement of expenses incurred at that subsidiary level for the activities incurred during the year. Next slide, please, Harleen. Again, now they want additional disclosures on affiliations with that 501c organization that assets were transferred to. Here, that's answered yes. You would describe the organization, the type, and the relationship of that affiliation. And then that will conclude the supplementary information here, and I believe I'll hand it over to Anand at this point. Oh, one more CPE question here.
Thank you, Arlene. The next few slides are really going to be statements that support the body of the return. But I want to spend a few minutes before on these statements before we get into Q&A. Arlene, if you mind, just scroll down a few more slides. One more. Okay. So here again, this is a description of the other expenses. Again, here you have to present them in a little more detail. Next. All right. I mentioned earlier that the disclosures require that you list every investment. You can't just put them in summary. And here's an example of that: ABC stock, Alphabet Inc. Again, regardless of the type of investment, it has to be listed individually. Next slide. Right. Here again, a little more about the PRIs, the fair value and the cost. Again, depending on the PRI, if it's an equity PRI, you may have fair value versus cost presentation. Next slide. I think this is also very important. We mentioned earlier about when Eric mentioned about grantees, whether they're foreign grantees or other private foundations where expenditure responsibility is required. This is a sample of that expenditure responsibility disclosure. But also keep in mind, foreign grantees, sometimes you may not need expenditure responsibility if there's an equivalency determination obtained for that specific grantee. In short, that's where there's a determination that that entity, the foreign entity, operates as a public charity here in the States operates. So again, that would no longer need a expenditure responsibility to be performed. Next slide. So that takes us into our last CPE. Did you enjoy today's presentation? Okay, thank you, Arlene. And Joe is going to take us through some of the questions that came through on the workshop. Joe?
Great. Thanks, Anand, and thanks, everybody. So we did receive a bunch of questions throughout the course of the presentation. I think a decent number of them ended up being maybe addressed later on in the presentation when Anand was going through the statements or what have you. Some of the questions are very specific in nature. So again, we might be following up with some of you individually afterwards. We'd be happy to answer your questions. But I did think that there were a couple, while we still have John Tyler, and I might ask for him to come back on camera, that maybe perhaps he can speak to, as well as some of our other speakers. So John, I'm going to start with yours because I think everybody always enjoys a self-dealing question or two. So we're just going to go through some of those. I think that while you covered the gala type of transactions, very much so how we typically talk about them. But again, I think that some of the questions were about whenever they sign up for a charity event for one of their grantees, they donate back all the tickets and nobody goes whatsoever. And I know you kind of talked to that, but then also there were some questions about things like golf outings and other things of that nature. And I know we've had to warn a few foundations before, the only thing that you're supporting are golf outings. Are you really hearing about the organization, so on and so forth? But can you just speak to a little bit more, maybe just go in slightly more detail about galas and whether or not the type of event weighs in, and what documentation may look like as a best practice for why it was deemed that the disqualified person should go to said event?
Sure, Joe. Thank you, and thanks to whoever asked the question, because it is a complicated area, and it can be very nuanced, and it's also regularly comes up because those sorts of activities are very common. As far as sort of the nature of the event, even for the disqualified person to go, it's not enough for the fact that the foundation has bought a table, and I think galas are a little easier to deal with than a golf outing. Because like you said, Joe, I mean, with a golf outing, the purpose is to golf, and that's a means to the organization raising money. There's not usually a lot of opportunities to engage with the organization, learn more about the organization. I suppose that if the disqualified person is there and a member of the staff, a knowledgeable member of the staff is part of the foursome, and there's intentionality around building relationships and getting to know the organization. So that gets into, it does matter, and the structure and approach will matter. Even in that context, though, if it's the disqualified person's spouse, business partner, friend, there's not a good foundation reason for that person to be participating in the golf tournament. There are a couple of ways to deal with these things, and I didn't mention this, but one of the things that can come up, and let's assume that disqualified persons are compensated. So even as a board member, they're compensated. If their spouse goes to the event and the foundation builds that cost into the compensation of the disqualified person, becomes taxable compensation to them, and it's the cost of the ticket, not just the non-deductible part. That's a way of trying to strike a balance, because a lot of times it's we want spouses to go so they can get to know the work of the foundation, get to know the other people at the table, and be more invested in the disqualified person's engagement. And this is a good way to do that. That's not going to be enough to avoid self-dealing, but if you count the value of the ticket as compensation to the disqualified person, there's probably middle ground of sorts that can be struck there. Joe, does that cover the question, or you might have some thoughts on that too?
I think it covers it perfectly, actually. And again, I always say, and not to be a Boy Scout here, but say, having documentation anytime somebody goes to an event and what is brought back from that event in terms of, we learned about this grantee, we learned about what they were doing, new initiatives, and just adding that to the grant file, I think is always, it's a very short and easy thing to do, but it kind of just recaps the event and the business purpose for attending. It doesn't have to be overly ornate, but this could help there. There was another question, still we'll stay with you, John, and then we'll get to some of the questions about the return, but these are about when you were talking, just shifting gears, talking about, I believe, professional services, and questions around who establishes or assesses what is considered reasonable, and how does a foundation find what's considered reasonable for personal services. And I don't think there's really an independent metric for that, but there's a way to go about it, and I know the way we typically talk about it, but why don't we start with you, and then maybe we can chime in.
Yeah, I think reasonableness is certainly a vague standard, but I think that there are ways, even looking at reasonable compensation for employees, for staff, for boards, and in a personal services context, I think part of the reasonableness, or among the ways to look at it, would be, and again, this presumes that personal services are provided to the foundation for the foundation's advancing the foundation's charitable purposes and operations. as opposed to engaging the person to provide personal services so that the person gets business, or so the person has something to do, so the person gets income. The purposes have to be in furtherance of the foundation, not the disqualified person or company. As far as reasonableness, a question that I would ask is, what does this person or their company charge other customers that they've got, and do the other customers pay that, or is this is this a markup because it's for the foundation, or it's a markup because they've got a sliver of upper echelon clients that they always charge more, but everybody else pays a lower price? If it's in the everybody else pays, that's more likely to be considered reasonable. If it's in the upper echelon, that may be problematic to justify, although it could get there, but I would be skeptical. So I think looking at sort of the normal course and scope of business of the provider and what they normally charge, what people normally pay, I think if the foundation has engaged other service providers in the space, they would have some sense of the market as well. So what do others charge? What does the foundation pay to other providers of similarly scoped services? And if that's in the ballpark, and especially if it's not over and above those amounts, it's going to be more likely to be reasonable. And to your earlier point, knowing it isn't enough. Documenting it is going to be key.
Great, thank you, John. And again, like I said, a lot of these questions are very specific, so I promise that we'll get back to each and every one of you with an individual response. And thank you for all of the kind notes that people are giving us with regards to thanking us for the session. But we'll go for one more question to Tom. Tom, just very quickly, there was a couple questions about when listing board members and managers, et cetera. There was a question about, does that apply to former board members or managers? And maybe you just have a couple thoughts on that part real quick, and then we'll wrap things up.
Sure, Joe. I gather it pertains to the section in the return where you list all your board members. And the rule is that if anybody is a board member, even 1 hour, 1 day of the fiscal year, they must be mentioned. So many times a board member will carry on to the first quarter of the following year. So there could be double the amount of board members reflected on the 990 PF. And I just want to add one other thing, and we're on board members, back to when Anand was handling that. In the old days, you could put as required or as needed for the number of hours worked. But then the IRS went out in their instruction booklet probably about 8-10 years ago and said, we must see a numerical number. So technically, if you ever look at a return and the number of hours, professional rights as needed or as required, technically that's a incomplete return and the statute is not running.
Great, thanks, Tom. All right, I think I'm going to turn it over to Anand to wrap us up and keep us on time. And thank you again from my side and from everybody else. But Anand, why don't you wrap us up?
Thank you, Joey. Thank you, Tom. Just want to start by obviously thanking our audience for joining us today. And we hope you found this workshop to be educational and informative. I also want to thank our speakers today for their time, for a job well done. A special thank you to John Tyler, our guest speaker. And of course, our PKF O'Connor Davies marketing team. Thank you for your help for putting this together. We know a lot goes on behind the scenes, so thank you, Harleen, Sandy, and the rest of the team. As Joe mentioned earlier, for those of you who submitted questions that we didn't get to, someone from our team will be getting back to you in the next couple of days. And lastly, a question came up about the recording. The recording of this workshop will be available along with our slides on our website. Probably sometime before the end of the day, if not first thing tomorrow morning. And while you're on our website, don't forget to download our recently published Private Foundation Governance and Tax Guide that Tom brought up earlier. Again, it's a great guide. So with that said, I would like to now pass it on to Harleen to take us through some housekeeping items. Harleen?
Thank you, Anand, and thank you again to all of our speakers, and thank you everyone for attending. Please remember to complete the short survey prompted at the close of this webinar. And like Anand said, a recording of today's webinar, a copy of the PowerPoint slides, and A link to our private foundation governance and tax guide will be sent and made available to all attendees via email within the next few hours. Thank you, everyone, and have a great rest of your day.